Opendoor wrapped up Tuesday's session in a way that really tells us where we are in this story, and where we're going. The stock closed at $4.70, up about 3.5% on the day. It wasn't a massive move compared to some of the fireworks we've seen over the past week, but it was another important building block. And as we look ahead to Wednesday's pre-market, the key theme I want to stress is this: the rally is still alive, but the path to much higher levels, to Eric Jackson's $82 target and beyond, is going to require patience, execution, and the right strategic shifts. Let's start with Tuesday's action. The stock ran as high as $5.28 intraday, which shows once again that the appetite to push this higher is there. But it couldn't hold those levels. Instead, we saw it trade back down into the $4.50 to $5 range and close right in the middle at $4.70. That's not a failure. That's consolidation. Think about the progression we've been watching. Just last week, the stock was battling between $3.50 and $4. Today we're talking about $4.50 as a floor and $5 as a ceiling. That's a higher range. That's progress. That's what healthy trading action looks like when a stock is trying to build a base after a big breakout. Now, the aftermarket was flat. The stock held steady with little movement. And that in itself is a kind of signal. It shows that there wasn't panic selling, and it shows that the $4.50 support is still intact. It tells me that the volatility is settling down into a structure. And that's where the patience comes in. We've seen big swings, the run to $5.87, the profit-taking pullbacks, the intraday rallies and rejections at $5. That's all part of the process. But if you zoom out, the story isn't about a single day's candle. It's about the trajectory. And the trajectory is still upward. But let's be clear, the road to $82, which is the long-term target Eric Jackson has laid out, is not going to happen overnight. That's a vision that plays out over years, not weeks. And for Opendoor to get there are three things that have to happen. First, they have to get the CEO pick right. Leadership matters, especially at a company that's in transition. Carrie Wheeler stepping down opened the door for a reset. Srisha Radhakrishna has done a great job stepping in as interim, engaging with retail, and reinforcing the company's pivot toward AI and operational efficiency. But ultimately, the board has to choose a permanent CEO who can scale this company, who understands marketplaces, who can push forward with an asset-light model, and who can carry retail along for the ride. That's not a small task. But it's also a huge opportunity. Get this right, and it sets the stage for everything else. Second, they have to continue repositioning as an asset-light business. The iBuyer model, while innovative, has been capital-intensive. Holding inventory, carrying risk, those are heavy burdens. The future of Opendoor, if it's going to reach those higher levels, has to be about efficiency. It has to be about monetising the funnel in multiple ways: agent services, financing solutions, technology partnerships, without tying up massive amounts of capital. That's how they boost margins. That's how they scale. And that's exactly what the retail letter submitted to the board was pushing for: a transition from being a capital-heavy iBuyer to being the Uber or Airbnb of housing. Third, the housing market itself has to improve. And here, the macro is starting to line up. Jerome Powell's comments at Jackson Hole made it clear that rate cuts are likely coming in September. Lower mortgage rates mean more buyers, more sellers, more activity, and that's oxygen for Opendoor's model. This is a company that thrives on transactions. The more people are buying and selling homes, the more opportunities flow through Opendoor's platform. So as the macro turns from headwind to tailwind, Opendoor stands to benefit directly. So when we talk about $82, we need to keep this in perspective. That's not about a single headline or a single trading session. That's about leadership, business model, and macro environment aligning over time. And that's why patience is needed. Now, that doesn't mean there isn't room for movement in the medium term. In fact, I think there is. With retail energy still strong, with short interest still elevated, and with the $5 level acting as a psychological battleground, there is scope for upward rallies in the near term. We've seen it time and again. When the stock builds a new range, it tests the ceiling, pulls back, and then eventually breaks through. If we get a clean break above $5 with volume, the next leg higher could come quickly. But the real test isn't whether it can touch $5.20 or $5.50 intraday. It's whether it can hold those levels and build from there. That's what I'll be watching as we head into Wednesday. Retail engagement continues to be one of the most unique parts of this story. On X, we saw criticism from a real estate agent pointing out that when Opendoor rejects a property in its iBuyer funnel, there isn't always a partner agent solution. That means customers can hit a dead end. Shrisha responded directly, admitting it's a problem and saying it's something the company needs to work on. That kind of honesty is refreshing, and it shows his listening. It also opens the door to new ideas. Could Opendoor develop its own small network of seller agents to plug those gaps? If done carefully, it could mean capturing leads that would otherwise be lost. It could create a more complete funnel and strengthen Opendoor's seller-first identity. Yes, there's a risk of looking like a traditional brokerage, but if it's approached as a hybrid model, powered by AI and only deployed in underserved markets, it could be a powerful complement. That's the kind of strategic flexibility that could accelerate the path to higher stock prices. And let's not forget the AI angle. Shrisha has been very clear that AI is now a core primitive for the company. Tools like Repair Copilot and Risk AI aren't just buzzwords, they're operational improvements that save money and scale faster. As Opendoor integrates more AI into its processes, the asset-light model becomes more achievable. This is how they differentiate themselves from traditional players. This is how they build margins. So as we look to Wednesday's pre-market, here's how I see it. The stock is consolidating in a higher range. The $4.50 floor is holding, the $5 ceiling is being tested. That's bullish progress. Retail conviction remains high, leadership is engaged, and the macro tailwinds are forming. The long-term $82 target is still on the horizon, but it requires patience, the right CEO, the asset-light pivot, and housing market improvement. In the short term, the play is about watching that $5 level. Can it break through with volume? Can it hold? If it does, the squeeze potential is real, and the next leg higher could come fast. But whether it happens this week, next month, or later, the story is still alive, and the fundamentals of the bullish case remain intact. So my message heading into Wednesday is this: don't get lost in the day-to-day swings. Volatility is normal. Consolidation is healthy. What matters is the direction of travel, and Opendoor is still moving upward. Patience is not just a virtue here, it's the strategy. The rally isn't over, it's evolving. And if the company executes, the upside is still enormous.